Import-export taxes for FDI enterprises. Vietnam is an attractive destination for foreign direct investment, FDI, enterprises, particularly in manufacturing, export, and trading sectors. However, FDI enterprises must thoroughly understand import-export tax regulations to ensure compliance and optimize costs. This article provides an overview of import-export tax regulations applicable to FDI enterprises in Vietnam, along with key considerations to minimize risks and leverage incentives. 1. Overview of import-export taxes in Vietnam. Import-export taxes in Vietnam are governed by the Law on Export and Import Duties No. 107/2016, QH13 and related guiding documents such as Decree 134/2016, NDCP. FDI enterprises engaged in import-export activities must comply with the following taxes. Import duties. Applied to goods imported into Vietnam, with varying rates depending on the type of goods and their origin, preferential, special preferential, or standard tariff rates. Export duties. Applied to certain exported goods, though most exports are exempt to encourage export activities. Value-added tax, VAT, applied to imported goods, typically at 10% or 5% depending on the type of goods. Note: FDI enterprises in industrial parks, IPs, or export processing zones, EPZs, may benefit from special tax incentives. 2. Tax incentives for FDI enterprises. Vietnam offers various tax incentives to attract FDI, particularly in IPs, EPZs, and special economic zones. Common incentives include import duty exemption, applicable to machinery, equipment, and raw materials imported for fixed asset formation or for producing export goods, per Article 16, Law 107/2016, QH13. Tax refunds. FDI enterprises exporting goods may be eligible for VAT refunds on imported materials used in production. Free Trade Agreement, FTA, incentives. Vietnam participates in multiple FTAs such as CPTPP, EVFTA, and RCEP, allowing imported goods from member countries to enjoy preferential tariff rates if they meet origin requirements. Risk. Failure to meet origin requirements or incomplete documentation may result in denial of tax incentives. Solution. Ensure complete Certificate of Origin, CO, documentation and work with tax experts to maximize FTA benefits. 3. Tax declaration and payment process. FDI enterprises must declare and pay import-export taxes through the Electronic Customs System, VNACCS, VCIS. The basic steps include submitting customs declarations and related documents, commercial invoices, contracts, CO, etc. Calculating and paying import duties and VAT, if applicable, within the stipulated timeframe, typically before customs clearance. Retaining customs records for at least 5 years for post-clearance audits. Risk. Errors in tax declaration or late payments may lead to administrative penalties or tax recovery. Solution. Use professional customs services or management software to ensure accurate and timely declarations. 4. Post-clearance audits. Vietnamese customs authorities may conduct post-clearance audits within 5 years from the date of customs clearance. FDI enterprises should note: prepare complete documentation related to import-export transactions. Ensure transparency in transactions related to goods value to avoid suspicions of transfer pricing or incorrect value declarations. Risk. Violations found during post-clearance audits may lead to tax recovery, fines, and reputational damage. Solution. Maintain clear and transparent records and collaborate with tax consultants to prepare for audits. 5. Additional considerations. Anti-dumping and safeguard taxes. Certain imported goods may be subject to anti-dumping or safeguard taxes, increasing costs for FDI enterprises. Changes in tax policies. Tax regulations may change annually, requiring enterprises to stay updated. Cooperation with tax and customs authorities. Building good relationships with tax and customs authorities can help resolve issues promptly. Conclusion. Import-export taxes are a critical factor for FDI enterprises operating in Vietnam. Understanding tax regulations, leveraging incentives, and strictly complying with legal requirements not only help enterprises minimize risks but also optimize operational costs. Partnering with tax and customs experts is key to success for FDI enterprises in Vietnam's import-export sector.